Well, here with his take is Ira Jersey. He's the head of interest rate strategy for RBC Capital Markets. Ira, good to see you as always. And do you agree? Are bond yields rising? Is that a canary in the mine or not?
Well, I think it would be a canary in the mine. We don't see them rising aggressively, however, as former Chairman Greenspan stated. We actually do think, though, that yields will rise primarily because of faster growth, because of concerns over supply, as the former chairman stated, but importantly, because basically things are getting better. If yields go up, and our forecast for year-end is that the 10-year will end at 450, but again, that's based on better growth, that's based on inflation expectations, modestly rising, and also a Federal Reserve that will shortly change its language, and sometime in 2011 will probably start to hike pretty aggressively.
Right, but as I recall from that interview, it wasn't just about inflation expectations that Greenspan was talking about, but also this fiscal debt, the fiscal overhang. That is what he's talking about greater difficulties in the bond markets.
Right, and certainly that is a concern. I think what we look at is how much fixed income product in general, how many corporate bonds, how many asset-backed securities, how many Treasury bonds, how many mortgage bonds are being created. And actually you have less being created this year, even with this massive Treasury issuance, you have less of in general as you did 2 years ago. So I think what you have to look at is total fixed income demand versus total fixed income supply. And that supply-demand dynamic actually supports fixed income assets in general. Now, there'll be some relative value moves between them. For example, corporates look cheaper than treasuries,
right?
And certainly that's one of the trades that we're recommending. But treasuries still don't offer terrible value, and I don't think you have to worry about a very sustained bull market in the 10-year. In the 2-year, completely different story.
But okay, before we get to the shorter term versus the 10-year, though, I mean, the 10-year near 4%, though, does that mean, given that supply-demand situation, even if it rises above that 4% yield, you're still not very worried, though?
No, I'm not worried about 10s going to 6% or significantly higher than that. I don't think that debt to GDP levels, for example, are really going to be that significant of a driver of 10 years yet. If there's not a credible plan that the administration and Congress come up with in the next 18 months or 2 years, then yes, perhaps it will be. But I think for at least the next year, we'll wind up looking more at economic fundamentals and not worrying about the credit quality of the United States.